when you hear the word divorce, it's easy to picture a certain kind of scene, you know?
Oh, sure. The argument over who gets the good silverware.
Exactly.
Yeah.
Who gets the dog, how to split the checking account, maybe who keeps the sedan. It's messy, but it's usually finite. The math is pretty straightforward.
Painful, but you can see all the pieces on the board.
Right. But today, we're talking about a completely different world. We're looking at Florida, specifically, and marital estates worth over $2 million. We're not talking about sedans. We're talking about private equity, medical practices on PGA Boulevard, complex business structures.
This is high net worth divorce. And it's not just a bigger version of a regular divorce. It's a fundamentally different beast.
We're digging into a guide by Thomas Davies from Davies Wealth Management called High Net Worth Divorce in Florida. And I have to say, my biggest takeaway from this whole thing is that if you walk into a Florida courtroom thinking, it's fine, we'll just split it all 50-50, you are walking straight into a buzzsaw.
That is, without a doubt, the single most dangerous assumption a business owner can make. The complexity, it doesn't just double, it compounds. You have illiquid assets, huge future tax liabilities, and business valuations that are, frankly, incredibly subjective.
So you're not just at risk of losing half.
No. If you aren't prepared, you could destabilize the entire company you spent your life building.
Okay, so let's map out this minefield. Because it seems like the very first trap is a word. The word equitable.
It sounds so nice, doesn't it? Equitable.
That sounds like equal.
And that's the trap. Florida is an equitable distribution state. It's not a community property state like, say, California, where you might get that clean 50-50 split.
In Florida, equitable just means fair.
Right. And fair is decided by the judge.
So it's totally subjective.
The court has enormous discretion. They start with the idea of an equal split, sure, but then they look at a whole list of factors that can push it one way or the other.
Like what?
The length of the marriage, each person's financial situation, but the big one, the one that really surprises people, is contribution.
And Davies points out that contribution isn't just about who made the money.
This is where high earners get completely blindsided. A surgeon might say, I built this practice from nothing. I worked 80-hour weeks for a decade. My spouse didn't bring in a single dollar.
And the court says?
The court basically says, so what?
Because the other spouse was running the domestic corporation, so to speak.
Precisely. If one spouse paused their career, raised the kids, and managed the home so the other could work those 80 hours, the court sees that as a direct contribution to building the wealth. It's a partnership.
That makes sense. I mean, it might sting the ego a bit, but it makes logical sense.
Yeah.
There's another factor you mentioned, something a bit more punitive. Conduct.
Right. This is the bad actor clause. And it's not about being a bad spouse emotionally. The court doesn't really care if you were grumpy.
It's about being a bad spouse financially.
Yes. Did you dissipate assets? Did you waste marital money on things that didn't benefit the marriage?
So legal speak for, what, wasting money?
Exactly. The classic example is buying an apartment for a mistress or taking secret expensive vacations. But it could also be gambling, reckless trading, or just draining accounts out of spite.
And if you did that, the judge can basically say, you already spent your half. Your spouse gets what's left.
That's it. Equitable lets the judge balance the scales with the bank account.
Okay, so before the judge can even slice the pie, they have to know what's in the pie.
Yeah.
This gets us to marital versus non-marital assets. It sounds simple.
It sounds very simple. Marital is what you got during the marriage. Non-marital is what you had before, or what you inherited or were gifted just to you.
What's mine is mine, what's ours is ours.
In theory. But this is where we get to the idea of commingling. This is where people accidentally give away millions.
It sounds almost like a chemical reaction.
It basically is. You mix a non-marital asset with a marital one, and it's almost impossible to unmix them. The court will often just call the whole thing marital.
Can you give me a real-world example of that?
Sure. Let's say you owned a rental property before you got married. It's in your name, clearly non-marital. But you use, say, $20,000 from your joint checking account to put a new roof on it.
You're just thinking, we're a team, it's all our money eventually.
And you just poison the well. By using marital funds to improve that non-marital asset, you've now given the marital estate a claim on it. Your spouse is now entitled to a piece of its value.
And I'm guessing the burden is on you to prove it's not marital property.
Exactly. And unless you have forensic-level records, which nobody does in a happy marriage, you're going to lose that fight. It happens all the time with inheritances. You get a check, you stick it in the joint account for a few weeks.
And boom, it's gone. absorbed into the marital Borg.
It's presumed to be a gift to the marriage.
There's another timing trap in the source material that I found really unsettling. The gap between the cutoff date and the valuation date.
Mm-hmm. They are almost never the same day.
And that feels like a huge gamble.
It is. The cutoff date is usually when you file for divorce. That's the line in the sand for acquiring new assets. But the valuation date, when the assets are actually priced for the court, that could be a year or two later.
And in a volatile market, a lot can happen in 2 years.
A huge amount. Imagine your stock portfolio is worth $5 million on the cutoff date. The market tanks. By the valuation date, it's worth $3 million. But if the court decides to use that earlier, higher value,
You have to pay your spouse half of $5 million, $2.5 million.
but you only have $3 million left in the account. You're left with $500,000. You've been wiped out. The fight over which date to use is a massive strategic battle.
Which brings us to the biggest battlefield of all, the business. For most high net worth people, the wealth isn't in cash. It's the dental practice, the law firm, the family company. And valuing that seems, well, dangerously subjective.
It is, without a doubt, the most contentious part of the whole divorce. It's the battle of the experts. Your accountant says the business is worth X, their accountant says it's worth 3X.
And the methods are all over the place.
Yeah,
The article mentions a market approach, income approach, asset approach.
right. Market is what a buyer would pay. Asset is what it's worth if you liquidate it. But the income approach, that's the really tricky one. It values the business on its future earnings.
So you're literally paying your spouse with money you haven't even made yet.
Correct. And this leads to what I call the tax strategy catch-22. This is where so many business owners shoot themselves in the foot.
Oh, I read this part 3 times. It's the ultimate irony.
It is. For years, as a smart business owner, what do? You minimize your taxable income, you run personal expenses through the business, the car lease, the club membership, the business trip to Hawaii. You show the IRS as little profit as possible.
All right. I'm just scraping by, Mr. Taxman.
But then the divorce happens. And your spouse's forensic accountant comes in and says, hold on, this business doesn't make $100,000 a year. We need to add back the Porsche, the Aspen trip, all these personal perks.
They normalize the income.
And suddenly, on paper, your business is a cash printing machine. The valuation skyrockets. So all those tax savings you got for a decade, you pay it all back and then some in the settlement because you just inflated the value of the very asset you have to buy your spouse out of.
You can't be poor for the IRS and rich for the divorce court.
You can't. And there is one potential shield here, which is the concept of personal goodwill.
It's not the business, it's me argument.
Yes. In Florida, value that's attached specifically to your reputation, your skill, your relationships, that's generally considered non-marital. It's yours. It leaves with you.
So if you're a famous chef, people come for your cooking.
Yeah.
If you leave, the restaurant is just a room with tables.
That's the argument. The opposite is enterprise goodwill. The value of a McDonald's franchise is the golden arches, not the owner. That's marital. So your goal is to argue, I am the business.
Okay, that is a lot of risk. Let's talk about solutions. The source outlines some clear protection strategies. Step 1 sounds like damage control.
It's immediate triage. Stop commingling. The second you even think a divorce is possible, open new, separate accounts.
The completely new bank. Walled off.
Totally. All your post-filing income goes there. Don't pay joint bills from it. You need to create a clean data trail. You're building a firewall.
And strategy 2 is more preventative. Your business's operating agreement.
Yes, this is something you should do now. Your agreement with your partners needs a divorce clause. It needs to say what happens. You do not want your ex-spouse suddenly becoming your new business partner with voting rights.
That sounds like an absolute nightmare for everyone involved.
It destroys companies. A good agreement can force a buyout or, better yet, preset a valuation formula so you aren't fighting about it later.
What about restructuring? Moving assets into trusts or using Florida's homestead protections?
Florida's homestead exemption is incredible protection, but, and this is a huge warning, you cannot do this in a panic. It's called a fraudulent transfer.
If you do it after the divorce is on the table, it just looks like you're hiding the money.
Correct. If you suddenly pay off your mortgage or move everything into an offshore trust after your spouse has threatened divorce, a judge will see right through that and unwind the whole thing, and they will not be happy with you.
Got it. And the last strategy is just about being smarter with the numbers. The tax reality check.
This is so critical. People just look at the top line number on an account statement. You have to look at the after-tax value.
Because $1 million in a traditional IRA is not worth the same as $1 million cash.
Not even close. You take that IRA, you have a huge tax bill baked in. When you pull that money out, you could lose 30–40% to taxes. Your spouse takes the $1 million house. They get to keep most of that value.
You got the account, they got the money.
You got shortchanged by hundreds of thousands of dollars. You have to negotiate based on what you can actually spend.
It seems like all of this comes down to who you have in your corner. Davies really stresses that it's not just about hiring a divorce lawyer.
In these cases, a generalist family lawyer is just not enough. But even more important is avoiding what he calls silos. You have your lawyer, your CPA, your forensic accountant, your financial advisor. If those people are not communicating constantly, they will sink your case.
What would that look like?
Well, your lawyer might be in court arguing that your income is really low to minimize alimony. At the same time, your CTA is telling a bank your business is booming to get a new line of credit.
Two completely different stories.
Exactly. And your spouse's attorney will find that. They will depose your CPA and use their testimony to destroy your lawyer's argument. The entire team has to be on the same page, singing from the same songbook.
It's like running a campaign. You need message discipline.
100%.
Okay, so let's tie this all together. We've talked about the equitable trap, commingling, the valuation minefield, and building a unified team. For anyone listening right now who owns a business, even if they're happily married, what is the one thing they should do?
It's about financial hygiene.
Clean up your books.
Clean them up.
Yeah.
Stop using your business account like a personal ATM. Keep inherited assets completely separate. Get a solid operating agreement in place. Honestly, these are things that just make your business healthier anyway. But if the worst happens, they become your only line of defense.
It's just so interesting. We think of the law as this rigid black and white system. But what I'm hearing is that high net worth divorce is incredibly gray.
It is a narrative battle. The judge has discretion. Your job is to provide the evidence, the paper trail, that allows them to exercise that discretion in a way that's favorable to you.
Which leads to maybe the most haunting idea from this entire deep dive. Since a judge's definition of fair is so subjective, you have to look at your own records and ask a really hard question.
What does my paper trail say about my marriage?
Yeah, that gives me chills.
Well,
We all know what our marriage feels like. But if you printed out 10 years of your bank statements, your business expenses, your wire transfers, what story would that stack of paper tell a stranger? Would it tell a story of a partnership or something else?
because in that courtroom, the paper trail is going to speak a lot louder than you ever will.
A sobering thought to end on. Thank you to Thomas Davies for the source material. This has been The Deep Dive.
Still protected out there.